And now, a very rare thing, some clear and simple advice as to how you can beat the stock market. Yes, that's exactly what I said. The specific situation is when companies go to the market looking for new equity, looking for a big injection of cash from their shareholders. Sometimes those share issues can be a bargain. Other times it can lose you a shed load of cash. And Pawel Bilinski has been studying this and thinks he can tell the difference between the two types of share issues, the ones which are good and the ones which are a dog. Pawel, you found, first of all, two types of reasons why companies go to the market looking for cash.
In order to appreciate what we do in our research, we have to take a step back and understand when the companies go and ask for equity financing compared to, for example, debt. And if you think about yourself as a manager of the firm, if you observe that in the market the price at which your stock is trading is below the fair value, then you have no incentive to issue new equity because that would be selling your stock at a price below the fair value. On the other hand, if you see that in the market the share is way above the fundamental value, then you have a lot of incentive to issue new equity and as much as you can. And we observe that if we take those two scenarios together now, among equity issuers, we'll see on average much more firms timing the market, trying to issue when the market conditions are favorable, compared to the ones that may need financing for new projects. Consequently, it's not really surprising that when you look at the performance of those firms that recently issued equity, in the long run, they perform very, very badly. So research shows, for example, that over 5 years after the company issues equity, performance of those firms tends to be 40 to 60% lower compared to peers. Consequently, if you're an investor, you need to know which rights issue, which equity issues I should participate in, and which ones we should avoid. And our research provides indications exactly what information to use to choose those companies.
And so what you're saying here then is that investors should concentrate on the share issues where a company is looking for money to invest, to do something exciting, and avoid the ones where they're just taking advantage of mispricing.
Exactly. So the key point here is that we may not know ex ante which companies are the ones timing the market and which ones are the ones who have genuinely new investment needs. Consequently, we need some pieces of information that will allow us to distinguish between those two. And in our research, we show that it's prospectus which is the most important source of information for investors. So we show that companies with genuine investment needs, the ones that have identified valuable new projects, they tell investors about it in their prospectus. They tell them about what are the investment needs that we need the financing for. On the other hand, companies that may not really have valuable investment projects say that, well, our needs are general, for example, or we need our financing for recapitalization needs. So consequently, they are much more vague about what really they need the financing for. In our research, we show that those companies that were very specific, that their needs is to finance new projects, are the ones that are performing very well after they issue new equity because they are not timing the market.
Okay, so other than reading the perspective, one other thing you found which gives a clear indication as to whether the share issue is going to be good or bad, and that's the quality of the underwriters.
Absolutely. So we show that one reason to look is that, whether the company will tell you we want financing for new investment projects. But on the other hand, you also have to see who is the underwriter for the new issue. We show in our research that high-quality underwriters are the ones that choose high-quality firms. So these are the ones that are unlikely to be timing the market because you, as an underwriter, have to protect your reputation. Consequently, you will choose only those firms to underwrite who have better prospects, who are unlikely to be timing the market. Consequently, if you look that this is a firm underwritten by high, respectable underwriter, you're much more likely to choose a company that will perform much better under the offering. On the other hand, if you have unknown, low-quality underwriter sponsoring a firm, then it's much more likely that this company may be timing the market.
Pawel Bilinski, thank you very much.
All right, thank you as well.